Welcome to the Deep Dive, the place where we cut through all that financial jargon and really get to the heart of what matters for your money. Today we're diving into something that, well, for a lot of people, feels pretty complex, maybe even a bit scary, investing. But let's maybe kick things off with an idea that might surprise you, to kind of flip the script a bit. You know what's often the real risk in the financial world? It's not actually investing, it's waiting.
That really is a powerful way to put it, isn't it? It feels, well, almost backward to how we usually think about risk. But the data, it consistently shows it. Most people actually lose out on more potential money by waiting for that mythical perfect time to jump in. They lose more doing that than if they just, started now, even if now feels kind of imperfect.
Mm-hmm.
Probably the biggest, most costly mistake we see is folks saying, oh, I'll just hang back, wait for the next big crash, then I'll invest.
Wow. Okay. That feels like a bit of a gut punch to the usual advice, doesn't it? Because we're always told, be careful, pick your moments, avoid risk at all costs.
Yeah.
But you're saying that being too cautious here could actually be the most expensive thing you do. Can you, give us a real example? Something that really drives home that cost of just waiting.
Absolutely. Let's paint a picture. Imagine you decided to invest in the S&P 500 index. That's basically a basket of 500 of the biggest companies in America. Maybe use an ETF, something like SPY. And let's say, just for argument's sake, you did this right at the end of 2007, like literally weeks before the huge 2008 financial crisis really hit. You basically bought in at what, looking back, feels like the absolute worst possible moment. The market didn't just dip then. It crashed hard. One of the worst downturns we've seen in modern times. Left a lot of people feeling, well, pretty terrified.
Oh, I remember that time vividly. The news was just constant doom and gloom, right?
Yeah.
Panic, bailouts. It felt like everything was collapsing. Seriously, scary time. Enough to make anyone just swear off investing forever.
It really was. But here's the key thing, the insight that just jumps out from all the sources we looked at. If you had simply held on to that investment, if you didn't panic and sell everything when everyone else was, by early 2025, that same investment wouldn't just be back to even, it would be up by over 300%.
Wait, 300% even after buying right before that massive crash?
300%. Think about that. Despite buying at what seemed like the worst possible time, it just powerfully shows the cost of doing nothing, that hidden penalty for hesitating. It really hammers home that the opportunity cost, what you miss out on by not being in the market consistently, it usually far outweighs the risk of those short-term drops, especially if you're looking long-term. It proves time and again that time in the market beats trying to time the market every single time.
That's a huge reframe of what risky actually means. It definitely goes against the grain and, wow, highlights a hidden cost most people probably never even think about. So, okay, that really sets the stage for what we're trying to do here today on the Deep Dive. We're here to cut through all that noise, the jargon, the hype. We want to provide real clarity, and most importantly, we want to empower you, the listener, to actually take control of your financial future. Because if there's one thing we've learned digging through, hundreds of sources, it's that simplicity, consistency, and just having the right mindset. Those are your superpowers in investing.
And that's exactly it. That's the core idea behind this deep dive. We've gone through, well, a lot of material, everything from basic beginner guides to, the really deep wisdom from market legends. And our goal is just to pull out the most important, most actionable stuff to make investing feel simple, smart, and actually doable for you, especially now in 2025. It's about getting you up to speed quickly but thoroughly, so you get the key ideas without feeling totally buried in information.
Yeah, that's the dream, right? To figure this stuff out without needing a PhD in finance. Just plain language. Surprising facts like that 300% thing, wow. And real practical steps you can actually take. Our goal is for you to finish listening and feel, smarter, way more confident, and actually ready. Ready to take your first step or maybe your next step in your own investing journey. So let's shift gears now. Let's really dive into how investing has changed, that 2025 mindset we need, the evolving landscape of investing, then versus now, the 2025 mindset. Okay, so it's pretty clear investing today isn't your grandpa's investing, right? That whole old mindset from before, say, the 2020s, it feels like it's really shifted. For someone just starting out now in 2025, what does that change actually look like practically speaking?
It's amazing how much has changed and how fast. It's really moved beyond those old ways of thinking. If you think about it, the old beliefs often came from a time when information wasn't flowing so freely, right? Access to data, to tools, it was way more limited. The modern investor now, in 2025, they've got incredible access to info, tons of tools, and honestly a different set of goals. It's shaped by tech, by different economic times. Let's break down a few key contrasts. Like the old way was often just buy blue chip stocks and hold them forever. Pick a few big, stable companies and just, sit on them for decades. Not much else to it.
That sounds really simple. Almost peaceful in a way, but maybe a bit too rigid for how fast things change now.
Exactly.
Too static. The modern mindset is much more dynamic, more flexible. It still values long-term investing, absolutely, but it blends that with agility. So you might balance having broad market exposure through ETFs, those smoothie baskets we talked about, giving you hundreds of companies at once, with maybe some tactical moves like shifting money into sectors you think will do well, or maybe even using options, but probably only after you've got a solid base. It's not about ditching long-term growth. It's about adding ways to adapt when the market changes.
Right, a more adaptive strategy. Okay, what about retirement? The classic advice. Max out your 401k or RSP and forget it till you're 65. Is that still the go-to? Well, that passive kind of set it and forget it approach, yeah, that was the main plan for a lot of people. And look, it wasn't bad advice back then. But it maybe lacked the strategic thinking needed for today's goals, the modern approach. It's all about tax optimization plus flexibility. Big focus there. This means really thinking about how you use different account types together. Like in Canada, your TFSA. In the US, your Roth IRA, your 401k. Plus maybe a regular brokerage account too. You're not just saving anymore, you're actively planning how to grow your money in the most tax-efficient way possible across your whole life. Thinking about maybe mini retirements, getting to financial independence earlier, not just that traditional retirement endpoint. It's about maximizing your net returns after tax.
That makes a ton of sense. Taxes can take such a big bite otherwise. Okay, and what about that age-old belief? Real estate is the best path to wealth. That one feels almost sacred sometimes.
It really does, doesn't it? And look, real estate can definitely still be a great way to build wealth, no doubt. But the modern investor looks at it, well, more broadly, with more diversification. Instead of maybe tying up all their capital in one physical house or condo, they might diversify using things like REITs. Those are real estate investment trusts, basically, companies that own lots of income-producing properties. You can invest in a whole portfolio of real estate that way, with much less cash up front. Or they might use fractional shares to own bits of big companies, use side hustle income to invest more, and definitely use global ETFs to get international exposure. It's not just about that one house down the street anymore. It's a much wider view.
That really shows a huge shift towards accessibility and playing in a bigger sandbox.
Yeah.
Okay, but how about getting advice?
Yeah.
Surely people aren't just picking stocks based on TV tips anymore. Please tell me that's gone.
You'd hope so. Unfortunately, yeah, some people probably still do. But relying on TV tips in 2025, it's not just outdated, it's actively harmful to your portfolio. The modern investor uses tools, sophisticated data-driven tools, platforms like VectorVest for deep stock analysis, TradingView for charting and seeing trends, educational YouTube channels for specific strategies, and increasingly even AI-powered screeners that can sift through just mountains of data to find potential opportunities based on what you're looking for. It's a massive shift from just passively hearing a tip to actively doing informed research using data.
Huge difference in empowerment there. Okay, and finally, maybe the most exciting change, moving away from work till 65, then retire to something else entirely, something earlier.
Yeah, this is maybe the biggest shift in aspiration, That old model, one long career, retire at 65 or later. It's really being challenged. People are exploring things like mini retirements, taking planned career breaks, or the whole FIRE movement, financial independence, retire early, or aiming for significant passive income streams. The goal often isn't just retirement, but achieving real financial freedom much earlier, maybe by age 40 or 50. That gives you so much more flexibility, more choice, more control over your life and your time. You're not just waiting decades to enjoy the fruits of your labor.
That's where it gets really exciting for so many people, I think. It's not just about getting rich, it's about getting freedom earlier. So if we put all these changes together, what does it really mean for you listening right now as a new investor? What are the core things driving people today?
That's a great question, right? What are the underlying desires? It's not just about piling up money. Today's new investors, they're really looking for clarity, for control, and for, actual results without all the unnecessary complexity. They're asking questions like, how can I actually retire sooner or just become financially free earlier? It's about having agency, having choices. They also really want to know, how can I automate this stuff? How can I simplify my investments? People don't want investing to feel like a stressful second job. They want systems that just work reliably in the background.
Yeah, that resonates so much. I think most of us want to set things up so our money works for us, not the other way around.
Right.
Without constant babysitting.
Absolutely. And another big one is, how can I actually use data and technology like AI, bots, these new apps to get a real edge? There's this awareness that tech can help, but also maybe some healthy skepticism. People want to understand how these tools can genuinely help them make smarter decisions, not just follow hype. And maybe the most pressing question for everyone right now, given inflation, how do I beat inflation without taking crazy risks? It's not just about growth anymore, it's about protecting your purchasing power, keeping your money valuable. The common thread through all of this, it's wanting clarity, control, and results, and really rejecting needless complexity.
Okay, this leads perfectly to something really crucial from one of our key sources. It's this idea that investing success isn't about being the smartest person, it's actually about your behavior. Can you maybe connect that to Morgan Housel's book, The Psychology of Money? Why is that message so incredibly important right now in 2025?
Oh, it's absolutely fundamental. Housel puts it so perfectly. He says, and this is a quote everyone should just internalize, doing well with money has little to do with how smart you are and a lot to do with how you behave. This is just profoundly true. Especially today, in this crazy, fast-paced, information-overloaded world we're in. You've got AI hype everywhere, endless tips on social media, crypto going up and down like a yo-yo. In this environment, mastering your emotions, your fear, your greed, that FOMO feeling, and just sticking to simple strategies, that's way more important than having the highest IQ. You could have the most complex algorithm, the best data, but if your emotions take over, if fear makes you sell at the bottom or greed makes you buy at the top, those emotions become your biggest enemy. They will absolutely lead you to make irrational, costly mistakes.
So it's less about fancy math or predicting the future and way more about just discipline, controlling yourself, preventing your own emotions from messing up your plan. Sounds like consistency beats genius.
Exactly. If you really think about it, especially for beginners, learning to manage your own financial psychology, that's probably the highest impact skill you can develop. It's about building good habits like saving regularly, investing automatically, and then having the mental strength to stick with those habits. Even when the market is screaming at you, trying to shake you out with big drops or tempt you with crazy rallies. I've seen incredibly smart people with complex strategies just completely blow up because they couldn't handle the emotional pressure on a bad day. That calm, consistent behavior, that's your real edge. And understanding this, the power of behavior, it perfectly sets up the simple, practical plan we're about to lay out. 2, the uncomplicated path. Your 3-step plan to start investing in 2025.
Okay, so behavior is king. We get that. And getting started is often the biggest hurdle, right?
Yeah.
You might be thinking, okay, sounds good, but how do I actually do it? And like we said, simplicity is your superpower here. Getting started is genuinely way simpler than most people think. No need for crazy complex stuff right away. So let's get practical. Step 1, what is it?
Step 1 is the absolute foundation. You just need to pick your account type. Simple as that. Where is your investment money going to live and grow? For our Canadian listeners, the TFSA, the tax-free savings account, is just fantastic. It's incredibly flexible. You can take money out tax-free if needed, and all the growth inside, completely tax-free, huge advantage. For our U.S. listeners, you're looking at cornerstone accounts like the Roth IRA or your 401k for that long-term growth and retirement planning. They have different but equally powerful tax advantages. Roth IRA gives you tax-free growth and withdrawals later. 401k gives you tax breaks now on your contributions.
Right, those are the main tax advantage ones, but it can feel a bit confusing choosing just one. Is there ever a case for, say, using both a TFSA and just a regular brokerage account? How does that work?
That's a really smart question, actually, because you don't have to choose just one. Often, combining them is the best approach for a really well-rounded strategy. A good way to think about it is blending those tax-advantaged accounts, your TFSA, Roth IRA, 401k, with a standard non-registered brokerage account. This gives you kind of the best of both worlds. You get that amazing long-term tax-free or tax-deferred growth for your big goals like retirement. But you also keep some money in a regular brokerage account where you might have easier, faster access to it if you need funds for something else, something sooner, maybe a house down payment or an unexpected emergency. It's about getting the tax efficiency for the long haul while still having some flexibility for life's curveball.
Okay, makes sense. Balancing act. So I've picked the right home for my money. Now, the big one, the question that I think stops so many people, what do I actually buy? Do I need to spend hours reading financial reports, trying to guess the next big tech stock?
Absolutely not. This is where simplicity really, really shines, and where so many beginners get tripped up by overcomplicating things. For your very first investment, we strongly, strongly recommend exchange-traded funds. ETFs. Let's use that analogy again. Think of an ETF like a perfectly blended smoothie basket of stocks. Instead of stressing about which single company, which perfect fruit is going to do well, you just buy the pre-made basket and boom, instantly you own a tiny piece of many, many different companies, diversified right away, across different industries, maybe even different countries, all in one go.
A smoothie basket, I love it.
Yeah.
So I don't have to worry about picking the next Amazon or Google, or worry if one company I pick suddenly fails.
Exactly right. The benefits are huge. ETFs usually have super low costs, so fees don't eat up your returns. They give you that instant diversification, which massively reduces the risk of any single company blowing up your portfolio. And honestly, it's just a much less stressful way to build wealth over the long run. You're not trying to find that one magic needle in the haystack. You're basically betting on the whole haystack, the broad market, or a big chunk of it to grow over time, which historically it does. For example, U.S. listeners might look at SPY, which tracks the S&P 500, or VTI for the total U.S. market. Canadian listeners, VIV is your S&P 500 equivalent, or you've got great all-in-one global options like XEQT or XURO. They handle everything for you: stocks, bonds, global diversification, all in one package.
That just makes so much sense. Takes a huge weight off, removes so much guesswork from that first big decision.
Yeah.
And I bet this lines up perfectly with what guys like Warren Buffett and Jack Bogle have been saying for years, right? Simplicity, broad markets.
You nailed it. It's precisely their core message. You should absolutely avoid trying to pick individual hot stocks when you're starting out. That's a classic beginner trap, usually driven by FOMO, and it can really hurt. Warren Buffett, he's consistently told average investors, even his own family, to just put their money in simple, low-cost S&P 500 index funds. And Jack Bogle, the guy who basically invented index funds and founded Vanguard, he's the one who said, don't look for the needle in the haystack. Just buy the haystack. It brilliantly sums up the power of these broad market ETFs. Let the market do the heavy lifting for you. Don't try to outsmart it by picking individual winners.
Okay. Message received loud and clear. No stock picking, at least not yet, by the whole smoothie basket, the whole haystack. Got it. What about dividends, though? Lots of people like the idea of passive income. Where do they fit in?
Yeah, that's a great point thinking ahead. Dividend ETFs can be a really nice addition later on. They generate that passive income stream. But they're probably something you think about after you've built that solid core portfolio with broad market ETFs. These dividend ETFs hold companies that regularly pay out profits to shareholders, so you get cash deposited into your account. And that becomes really powerful if you use DRIP's dividend reinvestment plans. The dividends automatically buy more shares, so it compounds faster. And super important, holding these in tax-sheltered accounts like your TFSA or Roth IRA makes that compounding even more powerful over the long term. Tax-free growth on top of growth.
Okay, so core ETF first, then maybe layer in dividends later for income, ideally in a tax-sheltered account. Makes sense. So account booked, smoothie basket ETF chosen. What's the final crucial step? The one that makes this all work without me losing my mind checking my phone every 5 minutes.
Step 3. This is where consistency meets calm. You need to automate your contributions, and then this is key. Learn to ignore the daily noise. This is, hands down, the key to consistent wealth building and, honestly, just reducing your own stress and anxiety around money. The strategy, it's called dollar cost averaging, DCA. Super simple concept, incredibly powerful in practice. You just set up automatic transfers, say every 2 weeks or every month. A set amount of money goes from your bank account directly into your chosen ETF.
Automatically.
So it doesn't matter if the market's up that day or down. My money just goes in regularly like clockwork. Feels like it takes all the emotion out of deciding when to buy. Exactly. That's the magic. You invest consistently. Same amount, same schedule, whether the market is flying high or taking a nosedive. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer shares. Over time, this averages out your cost per share, smooths out the bumps, and most importantly, it completely kills that temptation to try and time the market. The psychological win here is huge. By automating it, you basically take your emotions out of the driver's seat. You're not agonizing, is today the right day? Should I wait? Nope, the system just does it. Robotically. No feelings involved.
That's fantastic. Investing on autopilot. That's what so many people want. Okay, so if it's automated, how often should I actually be looking at it? Because I can totally see myself getting obsessed, checking it daily, which sounds like a recipe for disaster.
You're right. That's one of the biggest traps. Checking your portfolio every day or multiple times a day, it's a direct path to anxiety. And anxiety leads to bad reactive decisions. Watching those little daily wiggles up a bit, down a bit, it will absolutely mess with your head. You'll start seeing patterns that aren't there, panicking over nothing, or getting greedy at the wrong times. Instead, the advice is check maybe once a month, or honestly, even just once a quarter is fine for long-term investors. Those daily price swings are just noise. They don't matter in the long run. Focus on your long-term goal. Watch how your automated contributions are steadily adding up over years, not hours. And please, don't compare your real steady progress to those flashy Instagram screenshots of someone's supposed huge gain. That's usually not the whole story. This goes straight back to Morgan Housel's point. Behavior trumps everything. Your consistent, disciplined, automated approach, that's your real advantage, not watching the ticker tape. 3. What not to do. Avoiding common beginner pitfalls that don't list.
Okay, so we've got a clear, simple plan for what to do that feels really manageable. But now let's flip it. The other side of the coin, which is just as important, maybe even more important. What absolutely not to do. It's like you're starting this journey and there are these hidden traps, these mines you can step on. Making these common beginner mistakes doesn't just slow you down. It can cost you real money. Or worse, just totally kill your confidence right when you're getting started. So let's get into this essential don't list for anyone new to investing in 2025.
Yeah, this is the pitfall primer, definitely. Knowing these warnings is just as critical as knowing the right steps. And the very first one, maybe the most common one we see, it's classic. Don't try to time the market.
Yeah, that's the whole I'll just wait for the next big crash idea, right? It sounds so smart on the surface, like be cautious, wait for a sale, buy low. What's wrong with that thinking?
It sounds smart, but it's probably the single biggest mistake a beginner can make. The reality, shown by decades of market history, is this. Most people miss out on way more potential gains by sitting on the sidelines waiting for that perfect dip than they would ever lose by just starting now, even if the market drops a bit right after. Remember that 2008 example? Buying at the absolute peak before a massive crash? And still being up over 300% by 2025 if you just held on? That proves it. Peter Lynch, the legendary investor, he put it perfectly. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. The market just tends to go up over time, often recovering faster and climbing higher than people expect. Waiting usually costs you way more than you think.
Wow. Okay, so waiting for the perfect time is actually the riskiest move. Mind blown again. What's the next big mistake to avoid?
Number 2, don't chase viral stock tips.
Oh boy. The social media effect. TikTok, Reddit, Twitter. That FOMO factory, someone called it. It's so easy to get sucked into that hype, isn't it? Seems like everyone's talking about the next GME or AMC.
It is incredibly easy and incredibly dangerous for your money. Stocks that go viral like that, their prices often shoot up based on pure hype, not fundamentals. And then, just as quickly, they crash back down when the hype fades. Think about GameStop and AMC back in 2021. Huge surges, headlines everywhere. But the vast majority of people who jumped in late, caught up in the excitement, they bought high, and ended up selling low when the music stopped. Lost a lot of money. Our advice here is crystal clear. First, build your solid foundation. Get that core portfolio of diversified ETFs set up, like we discussed. Then, maybe, if you're really curious, you've done your own deep research and you understand the risks. Maybe you experiment with a tiny, tiny portion of your overall portfolio. Like less than 10% on individual stocks, but only after the foundation is solid.
Okay, crucial rule. Foundation first, speculation small, less than 10%. Got it. What other traps are out there for new investors?
Number 3, don't invest money you'll need soon. This is fundamental. Cannot stress this enough. The stock market is for long-term growth. It is not a high-interest savings account. You have to understand that difference. If you have money set aside for something important coming up soon, like a down payment on a car next year, tuition fees next semester, buying a house in the next couple of years, do not put that money in the stock market, period. The market goes up and down. It's volatile. And a big downturn could happen right when you need that cash, leaving you short for your essential goal. Keep short-term money safe and accessible.
Makes total sense. Emergency fund, house down payment fund, keep that separate, keep it safe. Okay, what's number 4 on the don't list?
Number 4, don't ignore fees and taxes. This one sneaks up on people. Lots of new investors see commission-free trading on apps and think, great, it's free. But that's not always the whole picture. You gotta watch out for other costs. For our Canadian listeners, things like foreign exchange fees when you buy U.S. stocks or ETFs, those can add up. Also, sometimes there are withholding taxes on U.S. dividends, even if they're held in your TFSA, which nibbles away at your returns. And for everyone, watch out for high MERS management expense ratios, especially on older mutual funds, but even some ETFs can have higher fees than necessary. These fees might look small, like 1% or 2%, but over decades, they can eat up a massive chunk of your potential growth.
Right. Those little percentages compound against you over time. So what's the easy way to avoid getting eaten alive by fees?
Keep it simple. Stick with those low-cost, broad-based index ETFs we keep talking about, things like VTI, VFE, XEQT. Their fees are usually incredibly low, very transparent. It means way more of your money stays invested and working for you, not going into someone else's pocket. Okay, number 5. Don't over-diversify too early.
Wait, but isn't diversification like the golden rule? Spread your money around. Don't put all your eggs in one basket. I hear people say, I own 20 different ETFs. I must be super safe.
It's a really common misunderstanding. Yes, diversification is absolutely crucial for managing risk, but there's a point where it becomes counterproductive, especially for beginners. Some people call it diversification. Funny term, but it's real. If you end up owning, say, 20 different ETFs that are all pretty similar, maybe they all track large global companies, just sliced slightly different ways, you're often just duplicating your exposure. You're essentially buying the same haystack multiple times, maybe paying slightly different fees for each slice. It adds complexity, makes it harder to track without really giving you much extra benefit, maybe even lower returns. Our advice for beginners: start simple, really simple. One good globally diversified ETF like XEQT or maybe VTI is often totally enough to get started. It gives you great diversification right out of the box. You can always add more specific things later as you learn more and your portfolio grows. But start simple. Even Ray Dalio, Mr. Diversification himself, his core message for beginners boils down to not betting too much on one thing, which a single broad ETF achieves beautifully compared to single stocks. Simplicity within diversification is key at the start.
Simplicity within diversification.
I like that. Okay, so what about those inevitable bad days when the market drops, like 10%? Because we know that will happen.
It absolutely will. And that brings us straight to number 6. Don't panic sell on red days. Every single person who invests will go through it. Your first big drop, maybe it's negative 10%, maybe more. It feels awful. It's visceral. Your stomach churns. But what you do in that moment, how you react, that really defines you as an investor. That determines your long-term success. Selling when the market is down, when fear is high, that locks in your losses. It turns a temporary paper loss into a real, permanent loss of capital. If you believe in what you own long-term, and if you own a broad market ETF, you should then act their downturns. They aren't disasters. They're actually opportunities. They're sales. A chance to buy more of that great asset at a lower price. That actually accelerates your growth when the market recovers, which historically it always has. This goes right back to Housel. It's all about controlling that fear behavior. Wow. So when everyone else is running for the exit screaming, that's potentially the time to calmly consider buying more, if you can. That takes serious discipline, but I see the logic. Powerful. What's mistake number 7?
Number 7, don't check your portfolio daily. We touched on this, but it's worth hammering home. It's such a huge trap, especially now with apps on our phones constantly pinging us. Checking obsessively, it just fuels anxiety. And anxiety, we know, leads to emotional, impulsive decisions, usually bad ones. Watching the tiny ups and downs every hour, every day, it messes with your psychology. You start seeing ghosts, reacting to noise. Discipline yourself. Check once a month, maybe even once a quarter. Set up the automatic contributions, trust the process, and walk away. Let compounding do its magic over years, not minutes.
Right, like watching paint dry, but in a good way. Let it happen. Okay, what about knowing why you're investing in the first place? Is that important?
Critically important. That's number 8. Don't invest without a clear goal. Just saying, I want to be rich. That's not a plan. That's a wish. It doesn't guide your decisions. Before you invest a single dollar, you need to define why. What is this money for? Is it for retirement? Decades from now? Is it for a house down payment in 5 years? Is it to generate passive income to live off starting in 10 years? Your goal dictates everything. Your strategy, the types of investments you choose, how much risk you should take, everything flows from that specific goal. Without a clear destination, you're just drifting. You'll get swayed by every trend, every bit of market noise.
Okay, got to have a why. Makes sense. What about needing to know everything before you start? Like, do I need to become a financial guru first? It seems like another reason people just never get started.
That's number 9. Don't skip the basics. Now, this doesn't mean you need a PhD, but jumping straight into the really complex stuff, That's a recipe for disaster. Trying to trade options or day trade crypto or pick penny stocks before you understand the fundamentals. It's like trying to drive a Formula One car the day you get your learner's permit. You're probably going to crash, and it could be painful. First, learn the essentials. What is a stock? What's an ETF? What's an index fund? How do taxes work on investments where you live? There are great resources. Investopedia has a simulator where you can practice with fake money, risk-free. YouTube channels like The Plain Bagel for Canada or Minority Mindset for the US break things down really well. Build that foundation first. It's your protection.
Foundation first, Ferrari later.
Got it.
Okay, last one on the don't list. And this one feels really relevant today, with social media showing us everyone else's highlight reel.
Number 10, don't compare yourself to others. Oh, this is such a huge mental trap for investors, that little voice in your head saying, my buddy made 500% on some random crypto coin, and I only made 10% in my boring ETF. I must be doing it wrong. That kind of thinking just crushes your confidence and can lead you to chase risky bets out of envy or FOMO. You have to remember, everyone's situation is different. Different starting point, different income, different goals, totally different tolerance for risk. Focus entirely on your race, your plan, your goals. Run your own pace. The data shows consistently that boring, consistent investors who stick to their plan almost always outperform the lucky gamblers and short-term traders over the long haul. Your journey is yours alone. Don't let comparisons steal your joy or derail your strategy. And maybe just one final overarching tip on this whole section. Think about your first year, maybe 18 months, of investing differently. It's not about getting rich quick. Please get that idea out of your head. That first year is your learning phase. It's your apprenticeship. Your goals for year one should be learn how your platform works, build the habit of consistent investing, actively avoid making these big mistakes we just listed, and figure out your own comfort level with market ups and downs. See it as education, as building a foundation, not as a race to $1 million. That mindset shift is huge. Ivy, wisdom from the masters, reinforcing core principles.
That's such a great way to frame it. Year one is for learning, not earning big. Takes so much pressure off. Okay, so we've covered the smart steps to take and the big mistakes not to make. But hearing these same ideas echoed by the actual legends of investing, the people who've done this successfully for decades, that adds a whole other level of confidence, doesn't it? It shows these aren't just our ideas, it's like the collected wisdom of the giants.
It really is fascinating how consistent their core advice is, even though they came from different times, had different styles. The fundamental truths remain the same. It just shows how timeless these principles really are. Take Warren Buffett, right? The Oracle of Omaha. He has said over and over again that the best thing most people can do is invest in low-cost index funds. Simple as that. He's even famously said that's what he wants done with most of his own family's money after he's gone. Just stick it in an S&P 500 index fund.
And he's got that amazing quote about patience too, right? Something like, the stock market is a device for transferring money from the impatient to the patient. That just sums up so much about behavior.
Exactly. That quote perfectly captures the importance of patience, of staying the course, of not letting short-term noise shake you out. It reinforces everything about dollar cost averaging and ignoring the daily drama. Then you've got Jack Bogle. The guy who founded Vanguard basically invented index funds for regular people. His whole philosophy was built on that mantra. Don't look for the needle in the haystack, just buy the haystack. It's the ultimate argument for simplicity, for broad diversification through ETFs, for keeping costs incredibly low. He empowered millions of people by making investing simple and affordable.
And Morgan Housel again, with the psychology of money. His focus on behavior feels like the common thread tying all these legends together, even if they didn't always say it exactly that way.
Absolutely. Housel's core idea that your behavior matters far more than your intelligence is just so critical. It explains why controlling your fear, your greed, your FOMO, why that's the real key to success. He argues for automating things, simplifying things, precisely because it helps you avoid those emotional traps. And it makes you think, right, if these brilliant financial minds all agree that behavior is the biggest challenge, what does that tell us about how we need to approach investing? Discipline is everything.
It tells me to automate everything and delete the stock app from my phone. Okay, what about Ray Dalio, founder of Bridgewater, huge hedge fund? He's known for really complex, diversified strategies. How does his wisdom apply to us beginners?
Well, Dalio operates on a whole different level of complexity, obviously, but his fundamental principle is totally relevant. Diversify. Don't bet too much on one thing. Know your risks. Now, for a beginner, that doesn't mean trying to build some super complicated all-weather portfolio like he does. No way. It means understanding that starting with one single, broadly diversified ETF is infinitely smarter and less risky than putting all your money into one or two individual stocks doing that YOLO thing. His message reinforces the wisdom of starting with broad diversification through simplicity, rather than taking concentrated bets. Build that solid diversified base first.
Okay, so Dalio's wisdom for us translates to start diversified with a simple ETF.
Got it.
And Peter Lynch, famous manager of the Magellan Fund at Fidelity, incredible track record. What's his key advice for us?
Peter Lynch offers a couple of really key insights. First, his famous saying, "Know what you own and why you own it." That just hammers home the need for basic education. Understand what's actually in that ETF you bought. Don't just buy blindly. And second, circling right back to our first, don't. He's the one who said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Another powerful voice telling us, don't try to time the market. Just get invested and stay invested.
Do what you own, don't try to time it. Simple and powerful. Okay, and lastly, J.L. Collins, author of The Simple Path to Wealth. The title alone sounds like he's on our wavelength.
Oh, completely. Collins is all about radical simplicity. He's a huge fan of VTI, the total U.S. stock market index fund, as basically the only investment you might need. His core message is so empowering. The market always goes up in the long term, but not every single year. That gives you the long-term perspective you need to ride out the inevitable bumps. His whole philosophy is about automating your investing, avoiding debt like the plague, and keeping your lifestyle simple. He just boils investing down to its absolute essence, making it feel achievable for anyone.
Okay, so if we take all this wisdom from Buffett, Bogle, Housel, Dalio, Lynch, Collins, what's the single unifying message? What do they all fundamentally agree on?
When you boil it all down, the consensus is remarkably clear and consistent. 1. Start early. Don't wait for the perfect time. That's Lynch, Buffett, Bogle. 2. Invest in low-cost, broadly diversified index funds or ETFs. That's Buffett, Bogle, Collins. 3. Automate your contributions and stay the course. Discipline. That's Housel, Collins. 4. Don't try to beat the market by picking stocks. Embrace the market's return. That's Buffett, Bogle, Dalio. 5. Avoid emotional decisions. Control fear, greed, FOMO. That's Housel, Lynch, Buffett. 6. Stay diversified, simply at first. That's Dalio, Bogle. And 7, maybe the most important, keep it simple. That's Collins, Bogle, Buffett. The amazing thing is, the most powerful advice for building wealth is also the simplest and easiest to actually follow. No complex secrets needed. V-Tools for the Modern Investor 2025.
That is such a great summary. Just reinforces everything. Okay, so we've got the mindset, the plan, the pitfalls to avoid, the wisdom from the legends. Now let's talk tools. Because the great thing about investing in 2025 is that there's so much technology out there to help us. It's never been more accessible. Where should someone even start looking for platforms to actually, do this stuff?
Yeah, the accessibility now is incredible. Technology has really democratized investing. Opening an account, it often takes just minutes online now. Super easy. For our Canadian listeners, popular choices are platforms like Wealthsimple, really user-friendly, often commission-free for basic trades, or Questrad, which maybe offers a wider range of options. In the US, you've got Robinhood, which kind of kicked off the whole commission-free trend for many, or Interactive Brokers, IBKR, which is maybe a bit more advanced but very powerful. These platforms have made it so much cheaper and easier to get started, especially with buying those simple ETFs we recommend. The barrier to entry is just so much lower now.
And it's not just about buying and selling, right? There are other tools out there that help you manage everything, track your progress, do research.
Exactly. It's a whole ecosystem now. Beyond just the place where you click buy, there are tools to help you be a smarter, more organized investor. For tracking your portfolio, seeing how everything's performing together, tools like Passive or ShareSite are fantastic. They give you a clear picture of your overall allocation, track your returns against benchmarks, and can even help you with rebalancing, keeping your investments aligned with your goals over time. That saves a ton of hassle. Then, when you're ready for a bit more research, maybe looking beyond your core ETF, you've got tools like VectaVest for detailed stock analysis. TradingView is amazing for charting, understanding price trends, technical analysis. FinViews is great for screening stocks, quickly finding companies that meet specific criteria you set. These tools help you do your own homework, make informed decisions, rather than just relying on tips.
Right, they're helpers, not magic wands. And what about learning resources? There's so much content out there now.
Tons. As we mentioned, good YouTube channels like The Plain Bagel or Minority Mindset can be great for clear explanations. Online communities on Reddit, like Reinvesting or Our Personal Finance, can offer different perspectives and a sense of community too. But, and this is a big but, always always be skeptical with online content, especially on forums and social media. Verify everything. Cross-reference with reputable sources. There's a lot of bad advice, biased opinions, and just plain misinformation out there. Critical thinking is essential.
Super important warning. Okay, so the tools make it easier to do the simple, disciplined strategy, but they don't replace the strategy itself.
Precisely. They help you implement effectively and efficiently. They save you time, reduce manual effort, maybe give you insights. But the core principles, simplicity, consistency, long-term focused behavior, those still rule. Outro.
So we've covered a lot today. The modern mindset, that simple three-step plan, the crucial don'ts, the wisdom from the masters, the tools to help. And as we wrap up this deep dive, I just want to circle back to that fundamental idea we started with. A lot of people think investing is inherently risky. They hear the crash stories, they see the scary headlines, and understandably, they hesitate. They stay out. But what we've really uncovered today is that the real risk, the often hidden risk, isn't in investing itself. It's in not understanding how money actually works in today's world.
It's fascinating, isn't it? The biggest risk isn't participating. It's the lack of basic financial knowledge most of us never got. Think about it. Most schools don't teach you what a TFSA or a Roth IRA is, or why the S&P 500 matters, or how inflation is silently eating away at your savings account right now. But the financial world doesn't wait for us to figure it out. Life doesn't wait. So the choice, really, for you, the listener, it's pretty stark. It's simple. Either you take control of your money, plan for it, protect it, grow it, or, well, someone else will. Whether it's inflation quietly stealing its value, or just the massive cost of missed opportunities piling up year after year.
And when you see the power of just being consistent, it's incredible. Let's make it real again for you listening. If you had just started putting away, say, $50 a week just 5 years ago into a simple diversified index fund, that smoothie basket, you'd likely be up somewhere between 40% and 60% today, roughly, depending on the exact fund. Think about that. No genius stock picking needed, no stressful day trading, no trying to time the market perfectly, just simple, consistent, automated action. It's truly amazing what happens when you just start and then just stick with it.
Which brings us to maybe one final thought, a provocative question for you to really ponder as we finish up here. Given everything we've talked about today, the proof that starting early works, the real cost of waiting, the simplicity of ETFs, the advice from the legends, what is the real cost of waiting for you personally right now? Is it lost potential growth? Is it inflation chipping away at your savings? Or is it just continuing to feel maybe overwhelmed, maybe not fully in control of your own financial future?
That's such a powerful question to leave things on. Really makes you think. If this deep dive helps you feel, smarter, more confident, maybe more empowered about taking control, think about what one small step you can take today, right now, to either get started or just improve things if you've already begun. Maybe it's finally opening that TFSA or Roth IRA. Maybe it's setting up that first automatic $50 deposit. Maybe it's just researching one of those ETFs we mentioned, like VTI or XEQT, just one small thing. And hey, if you know someone, a friend, family member, colleague who's still feeling stuck or scared or just confused by all this investing stuff, why not share this deep dive with them? Help them take back control of their time, their money, and ultimately, their future. Thanks for diving deep with us today.